Has gold's rally been cause for celebration or alarm? What's next for the yellow metal after this summer's spectacular run? Joining me today, Daniel Oliver, founder of Myrmikan Capital. Dan, welcome back to the show.
Thanks for having me back.
So a little bit different scenario today, right? Last time we spoke was back in May. Things were gloom and doom. People were talking about gold and death in the same sentence. And now look at us.
The word dire was the word you kept bringing up.
Right.
And it was dire. And the point I made back then was that gold just simply couldn't break 1350. We'd had so many runs at it, it never worked. And finally, we burst through it. And now, with that ceiling gone, you're seeing a lot of the momentum players coming in. I mean, it's always important to remember that institutional money is at essence momentum money, right? Their goal is not to be a hero. Their goal is to track the market, do what all their friends are doing, so they don't get fired. And once Ray Dalio said, okay, everyone should buy some gold, all of a sudden it gave the green light for institutional guys to say.
That really was a game changer. Yeah. If I had to pinpoint one moment in this summer, I mean, besides the other ones, that Ray Dalio coming into the market, would you agree was really a game changer for gold?
I don't think he convinced anyone. I think what he did was he gave them cover. Right, if Dalio is doing it, I can do it too. And because none of these institutional guys want to be heroes, I mentioned. So the consultants and the lawyers run everything. And once a guy like that says it's okay, then they can all do it. And what's interesting is that all that institutional money is trying to squeeze into a market that is very, very small. And it's hard to figure out how to do it. And that's what they're scrambling to figure out. So I think there's a lot of momentum behind this move.
So Dan, I need to bring up, you almost broke the internet with your gold call of $3,000. And I have to give you kudos because it's hard to stick your neck out with such a bold call, especially when we were in such depressing times. But look at us here, 1,500, 6-year highs.
Yeah.
So now you're sticking to 3,000 or has it moved higher?
No, I said at the time that was the first step, and I'm going a little along with that. If you think about the fact there are $15 trillion of bonds with a negative yield, and the total gold market is $10 trillion, it gives you a sense of how much capital there is out there that has a negative carry against gold, right? And all those bonds, of course, will devalue as the currency devalues. So there's a lot of pressure to get into gold. And we've just barely begun, I think, this cycle.
Let's play out a scenario. Let's say we do fall into a recession 1 to 2 years down the line, and people don't flock to gold, but turn to the U.S. dollar or treasuries as a safe haven. What happens to gold then?
Well, I mean, they will, of course, go to those places, the treasury market. But don't forget, what the Fed will do in that situation, what they're already talking about doing, is print money. I mean, that is all they can do is print more money, do more QE. And that is not good for the dollar. It's great for gold. Gold senses that, and that's why I think it's broken out here. Because I don't think it's 1 or 2 years the recession is coming. It's coming much sooner than that. All the medium-term economic indicators, freight traffic, and all those numbers that tell you what's happening.
What about the economic data that's pointing to a rosier picture?
Well, it depends where you look, but I always keep in mind, I think I mentioned this last time, when you look at the data on the Federal Reserve's website, they recorded unemployment as being 0.4% in October of 1929, right before the Great Depression started. And the reason is because we've been in a credit bubble, which means that there's been frenetic investment everywhere. And so unemployment is very low because you need bodies to do all that. But what happens in a bubble is you get overcapacity and rents start falling and then projects default on their bank debt. And that's what's starting to happen now. That's why the debt markets are wobbling. That's why central banks are scared. And so that unemployment number is a lagging indicator. It's not a leading indicator.
And then you mentioned the Fed. We're speaking here ahead of Jackson Hole. Does gold get a Jackson Hole bounce as it usually tends to get?
It depends what they say. But remember, the Fed has all sorts of tools in its toolkit. But it boils down to one thing. They either print money or they're not printing money. Or they're tightening or they're loosening. That's all they can do. And right now, they've been tightening for the last few years. And we hit that inflection point where they lowered rates just to test the waters, and the market wants more. All the interest rate futures markets are signaling they better lower rates more, or else the market's really going to be unhappy.
Turning to stocks now, your newsletter is focused on picking winners in the junior mining space. The $1 million question here is, that's great, gold's doing wonderful, but why isn't it spilling over into the junior miners? Why aren't they on fire?
Yeah, it's a great question, and the reason is because it's really easy for a fast money hedge fund or institutional money to go buy ETFs. So the first thing to do is they buy the GX, the GDXJ, and those ETFs have to reallocate the capital to the senior companies that they own. And there's really no conduit left to get capital into the juniors. If you think about how it used to work, as I'm sure you know, 10 years ago, the Canadian banks had analysts and promoters, and there were investors who would put risk capital to work. And that's all gone. All the banks have fired their people, and the investors are funding marijuana plants. And so right now, there's this big spread between what's happened to the senior companies and the juniors that have been left behind.
So what would you need to to happen? What kind of gold price would you need for the focus to shift back? Or is it more than price?
Yeah, the price is already there. You don't need the price. What you need is to get a conduit to get capital in those names. It's hard for a guy running $1 billion to go to research on $100 million, $50 million stocks. He just doesn't want to do it, so he buys ETFs. So what will happen eventually, to answer your question, is eventually intermediate companies in the space that need to build assets, that need to build reserves and resources, the easiest way to do it is to acquire juniors. That's just the easiest way to do it. So at some point, for the last 10 years, gold companies have had to compete to get capital, and what's going to happen shortly is that capital will compete to get into gold companies.
So we're going to see a lot more mergers and acquisitions taking place?
Correct, and investments, and be done at much, much better terms than currently.
All right, Dan Oliver, thank you so much for coming into the studio.
Well, thanks for having me.
Yeah, you got to come by more often.
Anytime.
Yeah, maybe you bring luck to the gold space.
We're going higher.
And thank you for watching. We'll have much more for you, so be sure to stay tuned to Kitco.com.